There has been much talk about the launch of the new BRICS gold and commodity-backed currency. Whether the BRICS Plus nations announce this currency this year or not, the intent to exit the highly inflated, faith-based fiat dollar is clear. To bring context to the BRICS currency and gradual de-dollarization, we will hear from experts such as Luke Gromen. Macroeconomist Luke Gromen is founder of Forest for the Trees LLC. Jim Rickards is an American lawyer, economist, investment banker, speaker, media commentator, and New York Times best-selling author on matters of finance, geopolitics, and precious metals.
I know a lot of Russians. I know the Chinese. I've been to Beijing, Shanghai, Moscow. They're not stupid, right? These are some of the smartest, savviest, most forward-leaning players on earth. So obviously they know what they're doing. But on a more serious note, I've spoken to senior officials at the IMF. I've spoken to senior officials in the U.S. intelligence community. I've had discussions about this at the Pentagon. Clearly, what they're doing is diversifying away from the dollar. Take China, for example. I mean, they're bleeding reserves. First of all, their reserve position has dropped. They fear, and I think rightly, that we're going to try to inflate our way out from under our debt. That's the American way. Like we don't actually default. We just inflate the currency away. So we say to China, here's your $1 trillion. Good luck buying a loaf of bread. And there's not much they can do about it. They say, why don't they dump the treasuries? Well, they can. I mean, the treasury market is large, but it's not that large. It can't absorb that much selling. But what they can do is buy gold, which they're doing by the thousands of tons, by the way. These are enormous purchases that are going on. And so you sit there with your big pile of treasuries and your big pile of gold. Now, China is the greatest friend of the dollar. China doesn't want to destroy the dollar. They want a strong dollar, because if you had $2 trillion of U.S. dollar denominated paper, you'd want a strong dollar too. So they say, look, if the U.S. maintains the value of the dollar, our gold might not do very much, but our securities will be worth face value, and we'll treat that as a very valuable reserve. But if the U.S. does inflate the dollar and does destroy the value of the paper, what's going to happen to the gold? It's going to skyrocket. So what you have is a hedge position where it's like a seesaw. They own both sides of the seesaw, and one goes up, the other goes down, but they maintain the value.
Some version of that is going to be the model going forward. I think it goes into things that better hold purchasing power, right? So it's going to be gold, hard assets, and they go invest in inflation hedged assets along the Belt and Road, some gold. And so I think it'll be a broad-based exodus out of FX reserves, out of Western sovereign debt as FX reserves. You know, that's a $12 trillion pool of money right now, probably 65% dollars. This was a fight that is always going to have to happen, because otherwise the U.S. is going to use the dollar system to choke out Russia, and then we're going to use the dollar system to choke out China, and then we're going to use the dollar system to choke out Europe, and probably in that order.
Russia, I think, probably is more strategic. They don't have all that many dollar-denominated reserves to begin with. They have a lot of euros. They do have some dollars, of course. But they're buying gold because I think they see continued financial warfare with the United States, and they want to reduce their vulnerabilities to freezes. I mean, the president can freeze Treasury securities because we in the United States control FedWire, we control the digital registry, we control the dollar-denominated payment system, but we can't control physical gold. And so Putin, I think, very intelligently is saying, all right, I'm going to buy the asset that the U.S. can't control, and that gives me more degrees of freedom. So some of it's economic, some of it's strategic, but all of it is very well thought out. And what I say to U.S. investors is, hey, if it's good enough for China and Russia, why isn't it good enough for you?
How do you hedge against an ever-depreciating fiat dollar? Own the opposite. Sound money. Sound money is built with assets that have scarcity, a long track record of trust and value, and cannot be printed by central banks. Gold's track record is clear, and so is the US dollar's. Fiat currencies have come and gone, but all the while, gold and precious metals have stood the test of time. Get started protecting your retirement savings today. See the links in the video description to get access to the free gold investment guides from the best gold IRA and gold investment companies that we have personally researched and vetted. Thank you for watching.